You know what keeps me up at night? It's not the gold price. It's not even the silver squeeze everyone's talking about. It's watching wealthy people, people who've done everything right, built real wealth, protected their families, make one catastrophic mistake that could cost them everything they've worked for. And the worst part? Most of them have no idea it's even happening. Let me tell you about Richard. Successful business owner, $4.2 million in retirement accounts, another $1.8 million in taxable investments. Smart guy. Really smart. He'd been buying gold through his broker for 3 years, felt good about it, felt protected. Then last March, when the banking crisis hit and he wanted to actually take possession of his gold, that's when he discovered the truth. He didn't own gold. He owned a promise, a paper promise from a bank that was now restricting withdrawals. The gold he thought he owned? It was allocated to 17 other people, and when he tried to get physical delivery, they offered him cash settlement instead, at a price $340 below spot. He lost $180,000 in a single phone call. But here's what really haunts me about Richard's story. He's not alone. There are thousands of high net worth individuals right now, sitting on what they think are gold positions, who are about to learn the same brutal lesson. And with what's coming in the next 72 hours, the window to fix this is closing fast. See, there's a strategy that the ultra-wealthy have been using for decades. The families with $50 million, $100 million, $500 million. The ones who've preserved wealth through world wars, currency collapses, and banking crises. They don't buy gold the way retail investors do. They don't even buy it the way most high net worth individuals do. They use something called checkbook control. And if you've got serious money in retirement accounts right now, understanding this strategy might be the difference between preserving your wealth and watching it evaporate. Let me show you exactly what's happening right now that makes this so urgent. 3 days ago, the COMEX reported something that sent shockwaves through the institutional gold market. Physical gold inventories dropped by 2.1 million ounces in a single week. That's $4.8 billion worth of gold that just vanished from registered vaults. Now, you might think that's just normal market activity, but here's what makes it terrifying. This is the 5th consecutive week of drawdowns exceeding 1.5 million ounces. We haven't seen sustained outflows like this since August 2020, right before gold ran from 1,900 to 2,070 in 3 weeks. But it gets worse. The ratio of paper gold claims to physical gold in COMEX vaults just hit 387 to 1. Think about what that means. For every actual ounce of gold sitting in those vaults, there are 387 people who think they own it. It's musical chairs, except when the music stops, 386 people are going to be left standing, and the music is about to stop. I've been tracking institutional gold flows for 17 years. I've seen 3 major delivery squeezes: 2008, 2011, and 2020. Each time, the same pattern emerges. First, you see registered inventory drawdowns. Then you see delivery delays. Then you see premiums explode. Then you see cash settlements forced on people who thought they owned physical gold. And every single time, the people who get crushed are the ones holding paper gold positions. The people who survive and profit are the ones with actual physical control. Now, most people think they understand the difference between paper gold and physical gold. They think if they buy gold coins or bars, they're protected. But there's a massive gap between owning physical gold and having checkbook control over physical gold. And that gap is where fortunes are lost. Let me explain what checkbook control actually means, because this is where it gets interesting. Traditional gold ownership, even physical gold ownership, has a fatal flaw. Let's say you buy $500,000 worth of gold eagles. You store them in a safe deposit box at your bank. You think you're protected, but you're not, because you don't control access. The bank controls access. And when there's a banking crisis, which we just saw the beginning of in March, banks can restrict safe deposit box access. It happened in Cyprus in 2013. It happened in Greece in 2015. It happened in Lebanon in 2019. And it's starting to happen here. Or maybe you're smarter than that. You store your gold at home. Now you've got a different problem. Home storage of significant gold holdings creates massive insurance issues, security risks, and here's the big one: IRS reporting requirements if you ever sell. Plus, if that gold is sitting in your personal name, it's exposed to lawsuits, creditors, and estate taxes. But the biggest problem with traditional physical gold ownership? You can't hold it in a retirement account without giving up control. And that's where most high net worth individuals have most of their wealth. In 401ks, IRAs, SEP accounts. Money that's locked up with custodians who control everything. This is where checkbook control changes the game completely. Here's how it works. You set up a specific type of self-directed IRA structure, not the standard self-directed IRA that most people know about, but a checkbook control IRA with an LLC structure. This isn't some loophole or gray area. It's a fully IRS-approved structure that's been tested in tax court multiple times, but most financial advisors will never tell you about it because they can't make money on it. The structure works like this. Your IRA owns 100% of a limited liability company. You are the manager of that LLC. The LLC has its own checking account. And that LLC can purchase physical precious metals, store them wherever you want, and you, as the manager, have direct access. No custodian approval needed. No waiting periods. No restrictions. You write a check. You buy gold. You take possession. Complete control. Now, before you think this sounds too good to be true, let me tell you about Margaret. She's a retired physician, $3.7 million in retirement accounts. She set up a checkbook control IRA 3 years ago, moved $1.2 million into the structure, used it to buy physical gold and silver, stored it in a private vault facility in Delaware that she can access 24/7. When the banking crisis hit in March and gold spiked to $2,050, she was able to sell a portion of her holdings within 48 hours, capture the profit, and redeploy into silver at $23. No custodian delays, no approval process, no restrictions. She made $340,000 in 3 weeks, all tax-deferred inside her IRA. But here's what's really powerful about this structure. It's not just about speed and control. It's about protection. When you hold gold through a traditional IRA custodian, you're exposed to custodian risk. If that custodian goes bankrupt, you're an unsecured creditor. Your gold gets tied up in bankruptcy proceedings. It happened with Lehman Brothers in 2008. Clients who thought they owned gold found out they were just creditors in a bankruptcy case. Some of them are still fighting to get their money back 15 years later. With checkbook control, the LLC owns the gold directly. It's completely segregated from any custodian's balance sheet. If your IRA custodian goes bankrupt tomorrow, your gold is untouched, because it's not held by the custodian. It's held by your LLC, in a vault you control, under your direct management. Now, I know what you're thinking. This sounds complicated. It sounds like something only ultra-high net worth families with teams of lawyers can set up. But that's the beautiful part. It's actually simpler than you think. The setup takes about 3 weeks. The cost is typically $3,000 to $5,000 for the legal structure and first year of administration. After that, it's about $1,500 a year in maintenance. For someone with $500,000 or more in retirement accounts, that's a rounding error compared to the protection and control you get. But here's where timing becomes critical. And this is why I said you've got 72 hours to pay attention to this. The COMEX delivery situation I mentioned earlier, it's accelerating. I've got sources inside 3 major bullion banks who are telling me the same thing. They're getting unprecedented delivery requests from institutional clients, sovereign wealth funds, family offices, ultra-high net worth individuals. People who've been holding paper gold positions for years are suddenly demanding physical delivery, and the banks can't deliver. Last week, one of the largest bullion banks in New York offered a client a $50 per ounce premium over spot to accept cash settlement instead of physical delivery. The client refused. The bank came back with $75 over spot. The client still refused. You know what happened? The bank delivered 3 months late and charged a $40 per ounce delivery fee that wasn't in the original contract. That's the kind of thing that happens when the system is under stress. And we're just at the beginning of this stress cycle. Look at what's happening in the physical gold market right now. Premiums on gold eagles are running $80 to $100 over spot. That's double the normal premium. Delivery times from major dealers have stretched from 2 weeks to 6 weeks. Some products are completely unavailable. The U.S. Mint suspended gold eagle production twice in the last 4 months due to blank shortages. That's code for, we can't get enough physical gold to meet demand. Meanwhile, gold ETFs are showing outflows. GLD, the largest gold ETF, has seen redemptions of 42 tons in the last month. Where's that gold going? It's being converted to physical and shipped to private vaults. The smart money is moving from paper to physical, and they're doing it fast. Now, here's where this connects to the checkbook control strategy in a way that could be worth millions to you. When you have checkbook control, you can move faster than anyone else in the market. You see an opportunity, you write a check, you execute. No waiting for custodian approval. No 3-day settlement periods. No restrictions on what you can buy or where you can store it. You operate like a sovereign wealth fund, not like a retail investor. Let me give you a concrete example of why this matters right now. 2 weeks ago, A private mint in Switzerland offered a limited allocation of 1,000-ounce gold bars at $15 under spot. These are LBMA good delivery bars, the same bars that central banks buy. The catch? You had to wire payment within 24 hours and arrange your own shipping and storage. A traditional IRA custodian would never approve that transaction. Too much complexity, too much liability. But with checkbook control, you wire the money, you arrange the logistics, you save $15,000 per bar. On a $1 million purchase, that's $150,000 in instant savings. These opportunities happen all the time in the physical gold market, but only if you have the structure to capitalize on them. And right now, with the stress building in the COMEX system, these opportunities are multiplying. But let me be really clear about something. Checkbook control isn't for everyone. If you've got $50,000 in an IRA, this probably doesn't make sense. The setup costs and complexity aren't worth it. But if you're sitting on $500,000 or more in retirement accounts, and you're concerned about what's coming in the financial system, this is something you need to understand. Quick aside here, I put together a comprehensive guide on how checkbook control IRAs work, including the exact legal structure, the setup process, and the top 3 custodians who specialize in this. It's completely free. I'll put the link in the description. If you've got $100,000 or more in retirement accounts and you're thinking about gold protection, it's worth checking out. Covers everything from the IRS rules to the vault options to the common mistakes people make. No obligation, just information. Anyway, back to why the next 72 hours matter so much. There's a perfect storm building in the gold market right now, and most people have no idea it's coming. Let me walk you through the pieces. First, you've got the COMEX inventory situation I mentioned. But it's not just COMEX. The LBMA in London is showing the same stress. Their vaulted gold holdings dropped by 87 tons in September. That's the largest monthly decline since March 2022. And unlike COMEX, the LBMA doesn't publish daily inventory data. By the time we see the numbers, the gold is already gone. Second, you've got central bank buying at levels we haven't seen in 50 years. The World Gold Council just reported that central banks bought 337 tons of gold in Q3. That's the highest quarterly purchase since 1967. And it's not just the usual suspects. Poland bought 57 tons. Singapore bought 42 tons. Even the Czech Republic is buying gold. These are countries that have been dollar-centric for decades. They're diversifying away from dollars and into gold. Fast. Third, you've got the commercial banks reducing their short positions. The latest COT report shows commercial shorts at the lowest level since 2019. That's significant because commercial banks are the smart money in the gold market. They short gold when they think it's going down. They cover their shorts when they think it's going up. Right now, they're covering, aggressively. Fourth, you've got the technical setup. Gold just broke through $2,050 resistance. That was a level that held for 8 months. When major resistance levels break, you typically see a rapid move to the next level. In gold's case, that next level is $2,150. But here's what's interesting. There's almost no resistance between $2,050 and $2,150. It's what technical analysts call an air pocket. Once gold gets moving, there's nothing to stop it. And fifth, this is the big one, you've got the derivatives market showing extreme stress. The gold options market is pricing in a 40% probability of gold hitting $2,200 by year-end. That's up from 12% just 3 weeks ago. The smart money is positioning for a major move, and they're doing it through physical delivery, not paper positions. Now combine all of these factors with what's happening in the banking system. We're not out of the banking crisis. We're in the eye of the storm. The Fed just released data showing that unrealized losses on bank balance sheets hit $684 billion in Q3. That's up from $620 billion in Q2. These are losses on treasury bonds and mortgage-backed securities that banks are holding. As long as they don't sell, they don't have to recognize the losses. But if depositors start withdrawing money, which they will when the next bank fails, banks will be forced to sell at a loss. And that triggers more bank failures. The FDIC's deposit insurance fund is sitting at $128 billion. Sounds like a lot until you realize there's $17.6 trillion in total deposits in the U.S. banking system. That's 0.7% coverage. If we see even a small wave of bank failures, the FDIC fund gets wiped out. And then what? The Fed prints more money to bail out the banks, which drives more inflation, which drives more people into gold, which creates more stress on the physical gold market. It's a feedback loop. and we're entering the acceleration phase. This is why checkbook control matters so much right now, because when this system comes under real stress, and it's coming, the people who survive are the ones who control their own assets, not the ones who have promises from custodians, not the ones who have paper gold positions, the ones who can walk into a vault and touch their gold. Let me tell you about what happened in 2008, because there are eerie parallels to what's happening now. In September 2008, right after Lehman Brothers collapsed, there was a run on gold. Not a run to buy gold, a run to take delivery of gold. Institutional clients who had been holding allocated gold positions at major banks suddenly wanted physical delivery, and the banks couldn't deliver. Why? Because the gold wasn't actually allocated. It was pooled, and it was leased out, and it was hypothecated multiple times. I remember talking to a hedge fund manager who had $50 million in allocated gold at a major Swiss bank. When he requested delivery in October 2008, the bank told him it would take 6 months. 6 months. For gold that was supposedly sitting in a vault with his name on it. He threatened legal action. The bank offered him a cash settlement at $50 below spot. He refused. Eventually, he got his gold. 9 months later. And when it arrived, the serial numbers didn't match the original allocation certificates. It was different gold, which meant his original gold had been leased out and sold. That hedge fund manager learned a brutal lesson. Allocated doesn't mean controlled. And in a crisis, control is everything. Now fast forward to today. We're seeing the same patterns. Delivery delays, premium explosions, cash settlement offers. The only difference is the scale. In 2008, gold was $800 an ounce. Today it's $2,050. In 2008, central banks were selling gold. Today they're buying it at record pace. In 2008, the derivatives market was $600 trillion. Today it's $1.2 quadrillion. Everything is bigger. Everything is more leveraged. And when it breaks, it's going to break harder. This is why the ultra-wealthy use checkbook control structures, because they've seen this movie before. They know that in a crisis, the only thing that matters is what you physically control, not what you think you own, not what your account statement says, what you can actually touch. And here's something most people don't understand about how the ultra-wealthy think about gold. They don't think about it as an investment. They think about it as insurance. Specifically, they think about it as insurance against government failure, against currency collapse, against the breakdown of the financial system. I was at a private wealth conference in Monaco 2 years ago. There were about 200 people there, all with net worths above $50 million. The keynote speaker was a former central banker who'd worked at the BIS, the Bank for International Settlements, the central bank for central banks. Someone asked him what percentage of a portfolio should be in gold. His answer shocked the room. He said, "If you're asking what percentage of your portfolio should be in gold, you're asking the wrong question. The right question is, what percentage of your wealth do you want to protect from government confiscation, currency devaluation, and financial system collapse?" Because that's what gold does. It's not about returns. It's about preservation. Then he said something I'll never forget. He said, "The families that have preserved wealth for centuries don't think in terms of portfolios. They think in terms of sovereignty. And sovereignty requires control, not ownership. Control. That's what checkbook control gives you. Sovereignty. The ability to make decisions about your wealth without asking permission, without waiting for approval, without being subject to someone else's rules. Now let me address the elephant in the room. Some of you are thinking, this sounds great, but isn't this risky? Isn't there a reason most people don't do this? Yes, there's a reason. And it's not because it's risky. It's because it's not profitable for the financial industry. Think about how traditional IRAs work. You put your money with a custodian. The custodian invests it in mutual funds, ETFs, stocks, bonds. The custodian gets paid. The mutual fund companies get paid. The ETF providers get paid. The brokers get paid. Everyone in the chain gets a piece of your money. It's a beautiful system. For them. Now think about checkbook control. You set up the structure once. You pay a one-time setup fee and a small annual maintenance fee. Then you control your own investments. No ongoing commissions. No management fees. No revenue stream for the financial industry. That's why your financial advisor will never tell you about this, because there's no money in it for them. But here's what's really interesting. The IRS has actually encouraged these structures. Why? Because they increase compliance. When you have direct control over your IRA investments, you're more likely to follow the rules. You're more aware of what you can and can't do. You're more engaged with your retirement planning. The IRS has audited these structures extensively. They've gone to tax court multiple times, and every time the structures have been upheld. As long as you follow the rules, and the rules are straightforward, you're completely protected. The main rules are simple. You can't use the IRA assets for personal benefit. You can't live in a property owned by your IRA. You can't borrow from your IRA. You can't sell assets to your IRA at inflated prices. Basic stuff. And with precious metals, it's even simpler. You buy gold. You store it in an approved facility or secure location. You don't take personal possession until you take a distribution. That's it. But the benefits are enormous. You get to choose exactly what gold products you buy. You get to choose where they're stored. You get to choose when to buy and sell. You get to respond to market opportunities in real time. And most importantly, you maintain complete control over your wealth. Now let me show you why this matters specifically for high net worth individuals in a way that it doesn't matter for smaller investors. When you've got $2 million, $5 million, $10 million in retirement accounts, you're not just worried about market returns. You're worried about systemic risk. You're worried about what happens if the dollar loses reserve currency status. You're worried about what happens if we see competitive devaluations. You're worried about what happens if the government decides to impose capital controls or wealth taxes. These aren't conspiracy theories. These are real risks that wealthy families have to plan for. And the way you plan for them is by maintaining optionality, by keeping some of your wealth in forms that can't be frozen, can't be devalued, and can't be confiscated. Gold is the ultimate optionality, but only if you control it. Paper gold gives you price exposure. Physical gold in a bank vault gives you ownership. But checkbook control gives you sovereignty, and sovereignty is what matters when the system comes under stress. Let me give you a real-world example of why this matters. In 2013, Cyprus had a banking crisis. The government imposed capital controls. They froze bank accounts. They restricted withdrawals. They even confiscated deposits above 100,000 euros to bail out the banks. It was called a bail-in, and it was completely legal under EU law. I know a businessman in Cyprus who had 2.3 million euros in bank accounts. Overnight, he lost access to 800,000 euros, just gone, confiscated to save the banks. But he also had 500,000 euros in gold stored in a private vault facility in Switzerland. That gold was untouched, because it wasn't in the banking system. It wasn't subject to capital controls. It was his, under his control. That 500,000 euros in gold saved his business. He was able to use it as collateral for a loan from a private lender. He kept his operations running while his competitors went bankrupt. And when the crisis passed, he sold the gold at a 40% profit because the Cyprus crisis had driven gold prices up. That's the power of control. That's why the ultra-wealthy structure their gold holdings this way. Now you might be thinking, that's Cyprus, that's Europe. That could never happen here. But it already has. In 1933, the U.S. government confiscated gold through Executive Order 6102. They forced citizens to sell their gold to the government at $20.67 per ounce. Then they revalued gold to $35 per ounce, instant 69% devaluation of the dollar. And if you didn't comply, you faced up to 10 years in prison. Could it happen again? Absolutely. In fact, there's already legal framework in place. The Trading with the Enemy Act and the International Emergency Economic Powers Act give the president broad authority to restrict or confiscate assets during a national emergency. And we've been in a continuous state of national emergency since 2001. I'm not saying it's going to happen. I'm saying it could happen. And if you're a high net worth individual with significant wealth in the traditional financial system, you need to think about these tail risks. This is where checkbook control becomes not just smart, but essential. Because even if we never see confiscation, even if we never see capital controls, even if the system muddles through, you still benefit from having direct control over your wealth. You still benefit from being able to move faster than the market. You still benefit from having optionality. And right now, with everything that's happening in the gold market, that optionality is worth more than ever. Let me bring this back to the immediate situation, the 72-hour window I mentioned at the beginning. Here's what's happening this week. The FOMC meets on Wednesday. The market is pricing in a 95% probability of a rate hold, but that's not what matters. What matters is the statement and the press conference. If Powell signals that rates are staying higher for longer, which he will, that's going to put more pressure on banks, more pressure on commercial real estate, more pressure on the treasury market. And when that pressure builds, people are going to look for safety. Some will go to treasury bonds, some will go to cash. But the smart money, the money that understands what's really happening, is going to go to gold, physical gold, and they're going to want delivery. That's when the COMEX situation goes from concerning to critical. Because if we see a surge in delivery requests on top of the existing inventory drawdowns, the exchange is going to have to do something. They'll either raise margins to discourage delivery, or they'll offer cash settlement incentives, or they'll change the contract specifications. They've done all of these things before. And when they do, the premium on physical gold is going to explode. We could easily see $200, $300, even $500 premiums over spot. It happened in 1980. It happened in 2008. It happened in 2020. And it's going to happen again. But here's the key. If you're stuck in a traditional IRA structure, you can't capitalize on this. You can't move fast enough. You can't access the physical market directly. You're limited to whatever your custodian offers. And by the time they approve your transaction, the opportunity is gone. With Checkbook control, you're positioned ahead of the crowd. You can buy physical gold today, at today's premiums, and store it securely. Then, when the premiums explode, you're sitting on instant gains, not paper gains. Real gains that you can monetize by selling back into the market at premium prices. This is exactly what sophisticated family offices are doing right now. They're not waiting to see what happens. They're positioning ahead of the move, and they're using checkbook control structures to do it.